The NASDAQ is down 29.4%, the Dow Jones is down 15.41%, and the S&P 500 is down 20.33% year to date. So the broader market has continued to decline in the month of June, but because I'm a value dividend investor, I know that this means I can buy quality dividend paying companies at lower prices and with higher dividend yields. So in this video, we're going to be going over 3 quality dividend paying companies that I'm going to be looking at adding to my dividend portfolio in the month of July. And the very first one that we are going to look at is Target stock. Now, Target has seen a huge decline in its share price year to date, and we can see they're currently down 37.69%. They even had a drop of 25% in a single date. Now, if we look at the market sentiment for Target, we can see there's a lot of articles that are currently very bearish on this company, but if we look right here at the very bottom of this article, we can see they raised their dividend by 20% as recently as June 9th. If we look at their financial statements, specifically the income, we can see their revenue has been increasing year over year pretty dramatically for the past 3 or 4 years. But let's go ahead and jump into my stock valuation spreadsheet to see if we can find a fair price for Target stock. So what we're going to do is we're going to come up here to the top and plug in Target stock ticker and hit enter. And if you'd like to be able to download any of the spreadsheets you see in this video, then you can head over to my Patreon page at the link in the description. But you can see now that I've plugged in the stock ticker, all of this data has automatically filled in. We can see at this current price, they currently have a dividend yield of nearly 3% and a payout ratio of just 27.8%. So a nice payout, nice low payout ratio. Their 20, 50, and 200-day moving averages are all down dramatically, but we can see analysts currently have a target price of $188 per share. But let's go ahead and look at our 4 valuation models for Target. And the first one we're going to look at is Graham's valuation. Now, Graham's valuation is a valuation model invented by Benjamin Graham in order to calculate intrinsic value, and we can see right here the formula he uses. And once we plug in all of these variables, we can see this valuation gives us an intrinsic value for Target of $299 per share. But let's go ahead and look at our discounted cash flow model. And in order to perform this model, what I did is I plugged in the historical free cash flows for Target, so we can see how much their free cash flow has grown year over year. And we can see since 2014, the average growth rate for their free cash flow is 20%. So that is a really phenomenal free cash flow growth rate. Moving forward, I am applying a growth rate of about 12% due to industry expectations and expectations for Target stock. And I applied that to all of the future free cash flows of this company. After applying everything else, we can see I came to a discounted cash flow price per share of $257. But let's go ahead and look at our multiples valuation. And you can see for my multiples valuation, I'm using price to earnings multiple and taking companies similar to Target like Walmart, Dollar General, and Kroger. And we see they have an average price to earnings of $21. Once we apply this $21 and multiply it by Target's earnings per share, we can see we come to an intrinsic value of Target to $255 per share. But let's go ahead and jump over to our dividend discount model. And the dividend discount model, I think, is a really important valuation model for dividend growth stocks. And essentially, what we're doing is we're valuing a company based on how much they pay out in dividends and how much that dividend is increasing. So what I've done is I've plugged in how much Target has been paying out in dividends quarterly over the past few years, so we can see their yearly dividend payout. After doing this, I can see the growth rate of these dividends, and we can see over this past year, they had a really large jump in their dividend growth. They had a 32% increase, which is absolutely astronomical. So now the average growth rate over this time period is 10.43%. Moving forward, I'm applying a growth rate of about 6% to their dividends with a discount rate of 9%. So the dividend discount model gives us a price per share of $127. So when we look at our output tab, we can see right here, we get an intrinsic value after we average all 4 of these valuations together of $234 per share. So Target price is currently undervalued according to our valuation model. Now, as a value dividend investor, we do always want to apply a margin of safety. So let's come here. Let's say we want to apply a pretty safe 30% margin of safety and hit enter. We can see based off of this, our acceptable buy price for Target would be $164 per share, meaning our valuation is telling us this is a stock that we should currently be buying. So despite the current bearish market sentiment, short-term investors do think this stock might continue to decline, but I think when I look at the financial statements for this company and look at these valuations, I think long-term this is a very strong company. And when we look at the dividend discount model, we can see that they are going to likely continue to grow the amount they pay out in dividends, which is one of the reasons that this company is on my watch list for the month of July. The next stock we are going to look at is Lowe's. Now, Lowe's is another stock that is down by a lot year to date. We can see they're down nearly 32% from their all-time highs for this year. They were trading as high as $255 $95 at the beginning of this year, but we can see they're currently trading at about $174 per share. Now, there's a lot of things that I currently love about this stock, but dividend growth is among the top of these. We can see they just recently announced another dividend increase. They're now going to be paying out $1.05 every single quarter per share, which is about a 25% increase. And before that, they recently had a 31% increase in their dividends. If we continue to scroll down, we can see their earnings per share is forecasted to rise by another 12.1% soon. Let's go ahead and jump into our stock valuation spreadsheet here, and we'll zoom out just a little bit. And what we're going to do is we're going to come up here and we're going to plug in Lowe's stock ticker and hit enter. And we can see all of this data will automatically load in. And now that we have this data loaded in, we're currently looking at a 300-day change, so we can see a huge decline in the stock price. If we come over here and look at our dividend data, we can see $4.20 per share every single year, giving them a dividend yield of about 2.4% with a payout ratio of 24.4%. Now, analysts currently have a target price of about $244 per share, and institutional ownership is about 80%, which is pretty high. But let's go ahead and look at our valuation models. And again, the first one we'll look at is Graham's valuation. We can see the formula here, and once I have everything plugged in, we can see we come to an intrinsic value of about $263 per share with Graham's formula. Let's jump over to our discounted cash flow model, and again, I plugged in the historical free cash flows for this company, and we can see since 2016, they had an average growth rate of 42.48%. That's pretty phenomenal. Moving forward, I'm applying a growth rate of about 10% to the future free cash flows. After adding in all the other variables, we can see we come to a discounted cash flow price per share of $261. Now let's jump over to our multiples valuation. And here on our multiples valuation, you can see we're using companies that are similar in structure to Lowe's and using a price to earnings multiple to value them. We come to an average price to earnings multiple of 18.32. We then multiply that by Lowe's earnings per share to come to an intrinsic value of $239 per share. Now again, let's look at our dividend discount model, and I'll repeat myself. The idea behind the dividend discount model is we should be able to value a stock based off of how much they pay out in dividends and how much that dividend is increasing. We can see over the last few years, they've had an average growth rate of nearly 18.52%, which is absolutely crazy, and that's without applying the 25% growth they're getting ready to see. So moving forward, I am applying a really high growth rate for this company of about 8%. I think that will be sustainable, especially since if we jump back over to our stock screener, we can see their payout ratio is just at 24.4%. So applying a growth rate of 8% to their dividends with a discount rate of 9%, we can see the dividend discount model gives us a price per share of $345. But let's jump over to our output tab where we can see all four of our valuation models. All four of them are currently higher than the current price for this company. When we average them together, we can see we come to an intrinsic value of $277.38 per share. Now, we always want to apply our margin of safety, and you can see here I've applied a 30% margin of safety, meaning our acceptable buy price for this company is $194, and our stock valuation spreadsheet is telling us this is a stock we should be buying. Now, I think there is also some risk involved with Lowe's when you consider the fact that most asset prices in our current market have continued to decline year to date, except for real estate. The real estate market is somewhat linked to Lowe stock, as we look at home improvement companies and home builders really rely on Lowe's for a lot of their materials. So if we do see a decline in the real estate market, Lowe's might follow. But long term, we're going to continue to see great dividend growth when it comes to this company, which is one of the reasons that they are on my watch list for the month of July. Now, the very last thing that we are going to look at for Lowe's is their income statement. And again, we're just going to take a glance at their revenues. And just off a glance, we can see their revenues are continued to increase at a pretty rapid rate. It even continued into 2020, 2021, and again in 2022, which is another one of the many reasons that I really like Lowe's stock long term. Now, the last stock that we are going to look at is Apple stock. Apple stock is currently down 24.5% year to date, and we can see they're trading at about $137 per share, which is pretty low when you consider the fact they were as high as about $180 per share earlier this year. But let's go ahead and look at the financial statements. Again, we're going to be looking at the income statement. We can see a pretty drastic increase in total revenues from 2018 to 2021. Now, something everybody loves about this company is it's a blend of both growth and value. This is one of the largest technology companies in the world with its market cap of $2.2 trillion, but despite this, we can see they're still able to grow earnings by 71%, and they saw sales growth of 33% in the past fiscal year. But let's go ahead and jump into our stock valuation spreadsheet once again, and we're going to come up here and we're going to plug in their stock ticker. So I'll plug this in, I'll hit enter, and we can see all of this data is gonna automatically load in. Again, if you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. But we're currently looking at a 365-day change, but let's go ahead and zoom in just a little bit more, and we'll look at a 250-day change. I'll hit enter here, and we can see a huge decline in the stock price. Dividend is currently $0.92 per share, giving them a dividend yield of about 0.67%. So although their dividend yield is bad, their payout ratio is low as well at 14%, but this is gonna allow the company to grow at a pretty rapid rate. Again, current price at $137, but analysts currently have a target price of $187 per share. Now let's go ahead and look at our valuation models, and again, the first one we'll look at is Graham's valuation. If we zoom in a little bit closer here, we can see once we plugged in all of the variables listed here, we come to an intrinsic value of $128 per share, which was a little bit lower than I was expecting. But let's go ahead and look at our discounted cash flow model now. And here in our discounted cash flow model, again, I plugged in the historical free cash flows for Apple. We can see they've had an average growth rate since 2016 of about 12.75%. I think that's gonna be pretty accurate moving forward. So I applied a growth rate of 12% to the future free cash flows of the company. I then found the present value of those future free cash flows and added the cash and cash equivalents. Subtracted the total debt to find the equity value, divided by the shares outstanding to find a discounted cash flow price per share of $177 for Apple. Now let's look at our multiples valuation. Now, obviously, we're going to have to use FANG stocks to use the multiples valuation for Apple. So we're looking at companies like Microsoft, Google, Amazon, and Meta. We found they have an average price to earnings currently of about 32.68. So after applying that to Apple's earnings per share, we can see we came to an intrinsic value of $201 per share. Now, lastly, we are going to look at the dividend discount model for Apple. We can see they had an average growth rate of about 5 to 6 to 7% pretty consistently, which is solid dividend growth. I applied an average growth rate of about 6%, as we can see right here, 6.5%. After applying a discount rate of 8.5%, we can see our dividend discount model only gave us an intrinsic value of $49 per share. So obviously, this model is not the best way to value Apple due to the fact they are still focused more on growth, although they are continuing to increase their dividends by a pretty decent bit. So when we jump over to our output tab, this is a valuation we're going to remove from our overall intrinsic value. So after we average our three models we have listed here, we can see we came to an intrinsic value of about $168 per share. Now, when we apply our margin of safety of 30%, you can see our stock valuation spreadsheet is not telling us this is a stock we should be buying. It says our acceptable buy price is about $118 per share. But what you have to understand about high quality companies like Apple, Microsoft, and Coca-Cola, companies that Warren Buffett really likes, these companies are typically not going to usually hit their current price with the margin of safety applied due to the fact that they always trade at a premium. Investors love these companies because they know they're so strong, some of the strongest companies in the world, and due to that fact, it typically will not ever hit that acceptable buy price. So if you are considering buying into Apple, I would go ahead and buy in at a price where it's a lower margin of safety, more like 10%. But go ahead and apply a margin of safety that you feel comfortable with. If you are looking to retire within the next 5 years, maybe this isn't a company you want to consider due to the fact that their dividend yield is currently pretty low. Like I said, if we jump back over to our stock screener, we can see it's currently only sitting at about 0.67%, but the dividend growth is pretty solid if you are a long-term dividend investor. So there you have it. Those are my 3 dividend stocks that are on sale in the month of July. If you'd like to be able to download any of the spreadsheets used in this video, then you can head over to my Patreon page at the link in the description. So that being said, go ahead and let me know in the comments below what your thoughts on each of these stocks are, and please don't forget to leave a like and subscribe to the channel.